Hey there, everybody. Thomas Wood with Basecamp Trading. It is Tuesday, May 2nd, and we're going to take a look at a pennant breakout. And we're going to continue with the price action trading series, and we're going to talk about crude oil today. What happened? If you follow me on Twitter and StockTwits, which hopefully you do, I sent this message out before this broke out this morning when we were bouncing off the upper end of the pennant. It said, watch for the 120-minute pennant breakout. We were bouncing off the upper end. Well, we obviously bounced off and came down quite a bit after breaking the lower end of the pennant. But what we're going to talk about is trading a pennant breakout and how you actually trade that. So a pennant forms when you have a narrowing range. So we had a really wide range here, and then we got narrower, and then we got narrower. Okay, so we had a narrowing range. You draw a trend line across the tops and across the bottoms, and then you look for the breakout. Now, if you want to have the aggressive trade entry, if you're looking for the aggressive trade entry, then that means you are entering as soon as it breaks through. Now, when it breaks through, you want to make sure it doesn't just break the trend line, but it also gets through the pivot low if the pivot low is close to the trend line. So in this case, the pivot low was at 48.54. Trend line break was just above that at about 48.60. So about 6 ticks higher. That means you wait for the pivot low break instead of entering on trend line break. That way it doesn't break down, hit that support, and then reverse right back up and have a false breakout and chop you up. So if you're trading that breakout and you're taking the aggressive entry, you're selling it once it's through that support, and your stop is going above the previous bar or the current bar's high. Now, if you want to play it safer, what you can do is you look at the when you're watching for the price action to break out. Sorry, I lost my train of thought there. If you want to play it safer, when you're looking at the price breakout, instead of trading it when it breaks, you wait until it closes above or below, and that'll kind of confirm that it's actually getting outside of that range, and that it's making the probabilities of having a false breakout a little bit lower. So you can wait until it closes outside. And if you do that, then again, price, once you get in, your stop goes above the previous price bar's high. So in this case, you would have been selling at about 44 with your stop at 80. All right. So $350 contract worth of risk. Now, if you want to take it one step further and you want to be even safer with the trade, what you do is you drill down to something like a 5-minute, a 2-minute, or a 500 tick chart. So let's see what that looks like. And we'll go to a 5-minute price chart, for example. And this is where that support was, all right, 54. You wait until you break down, and then you time your entry with a breakout, for example, like we had right here, where crude went into this little channel, started moving sideways on the 5-minute chart, and then you break out of that 5-minute channel, and that's where you time your entry. And now you're going to be selling at 25 or 26 with your stop above the previous bar's high at about 36. So now you went from having $400 or $350 of contract risk to having about $100 of contract risk. So as you drill down, your risk will become lower and lower. All right. So that's all I have for you for today. I hope it helps. I hope you enjoyed it. I will see you in the trading room bright and early tomorrow morning. Don't forget, make sure you follow me on Twitter and StockTwits so that you can get these types of setups as they're coming out throughout the day. But that's it for today. I'll see you in the trading room bright and early tomorrow morning. And until next time, happy trading.